US consumer confidence slumps into recession territory. Australia's budget reveals a surprise tax cut, while future spending plans sit near expectations. And oil prices fall as Ukraine agrees a partial ceasefire. That's coming up in our 5 Things in 5 Minutes on Wednesday, March the 26th. And then in today's bonus deep dive interview, ANZ senior international economist Tom Kenny analyses how the Federal Open Markets Committee's projections for the US economy have changed and how rising uncertainty is hitting the world's largest economy.
A persistent period of elevated uncertainty would almost certainly be growth negative and thus disinflationary. It is too early at this stage to project how long uncertainty will remain elevated.
But first, in 5 and 5 with ANZ, there were growing concerns about US growth overnight as the Conference Board measure of consumer confidence slumped 7.2 points in March to 92.9. That's below expectations for a reading of 94. ANZ economist Bansi Madhavani says while assessment of current conditions slipped 3.6 points, it was the key expectations component which drove the overall measure down.
It is now well below the threshold of 80 that usually signals that a recession lays ahead. In fact, the expectation index is now below the pandemic low and is at its lowest level in nearly 12 years. What is weighing on consumers? It's pessimism about future business conditions. It's the fall in confidence about future employment prospects. And it is also the worry about future income prospects. So these concerns around labour market and economy are now spreading into consumers' assessment of their own personal situations.
As of 4 a.m. Sydney-Melbourne time, the US dollar index was down 0.2%, while US Treasury yields were down around 3 basis points. The S&P 500 was up 0.1% off its intraday highs following those confidence numbers. West Texas Intermediate oil futures were down 0.5% at $68.69 US a barrel after the Ukrainian president announced a partial ceasefire. The Aussie dollar was up 0.3% at 63.05 US cents, while the Kiwi was up 0.2% at 57.38 US cents. Number 2. Australia's federal government revealed its budget last night, proposing a new round of tax cuts as a centrepiece policy. ANZ Head of Australian Economics Adam Boyton says the key headline number to look at is the underlying cash balance, which will be in a deficit of 1.5% of GDP in 2025-26. And that's up from 1% of GDP in the current year.
It's expected by the Treasury to be in deficit to the tune of $42.1 billion in 2025-26. Our own expectation was a $40 billion deficit, so not a huge difference there. If I look at what were the surprises in the budget, clearly the big surprise is that tax cut that comes into effect from the 1st of July 2026. It is in the first year quite a modest income tax cut. The cost in that first year, 26-27, is only $3 billion. It then builds to $6.7 billion in the next year, where over that year it will give someone on average earnings around a $535 a year tax benefit.
Number 3. Adam says the initial modest size of the tax cuts means they fit within the envelope of fiscal easing ANZ Research has been expecting over coming years.
Yes, the form of the fiscal easing is a bit different, but the quantum isn't. So there's no impact on our real GDP, our trend mean inflation, or our RBA forecast coming out of this budget. We still expect only one more interest rate cut in Australia, most likely in August this year.
Number 4. In the lead up to the budget, last week's ANZ Roy Morgan Australian Consumer Confidence measure rose 0.4 points to 84.2, led by the time to buy a major household item index. But as ANZ economist Sophia Angala points out, the rise did little to offset a weaker month in the series.
Looking on a 4-week moving average basis, the series is now at its lowest level since October of 2024, and global uncertainty may be weighing on consumer confidence as a whole. Households are feeling less confident in their financial and economic conditions, with all financial and economic outlook sub-indices now sitting below their averages that they held over the second half of 2024 after we saw the introduction of their Stage 3 tax cuts.
Number 5. Markets in Australia today are focused on February CPI data for clues on where the Reserve Bank of Australia might take rates this year. ANZ senior economist Adelaide Timbrell is expecting an annual read of 2.6%, up from 2.5% in January.
The key contributions to this slightly higher inflation will be the continued roll-off of electricity rebates, which last month increased by 8.9% in the month, just due to the roll-off of rebates and people actually paying more of their energy bills, particularly in places like Queensland. An increase in fuel prices, which we expect to be around 1.2% month on month, and then potentially stronger than usual education fee increases, which are enacted in February. This will be somewhat offset by a likely seasonal fall in holiday prices.
Adelaide Timbrell there. Now, in today's bonus deep dive interview, ANZ senior economist Tom Kenny analyses the FOMC's latest forecast for the US economy and interest rates amid all of that rising tariff and policy uncertainty.
The Fed made two notable changes to its macro forecast at its March meeting relative to the December meeting. Firstly, real GDP growth for 2025 was revised down to 1.7% from 2.1%. Secondly, core PCE inflation for 2025 was revised up to 2.8% from 2.5% in 2025. The 2026 and 2027 forecasts for GDP and inflation were little different to those made in December. The revisions to GDP, we think, largely reflected the slow start to the year for household consumption, and the upward revision to inflation reflects the pickup in goods inflation that we've seen in January and February, which Chair Powell flagged as being tariff-related. What is notable about the GDP and inflation forecast from the FOMC is that virtually all members see downside risk to GDP and upside risk to inflation. Powell noted that the change in forecast to GDP and inflation in 2025 more or less offset each other in terms of implications for monetary policy. This is why the Fed left its base case for easing in 2025 as 2 25 basis point cuts.
So those two more rate cuts, how does that compare to what the markets are saying and what we need to see happen for these cuts to be made?
The market has almost 3 cuts priced for this year. To ease policy further, we think the Fed would like greater certainty on the return of inflation to 2% sustainably. In the next couple of months, there is likely to be a lot of noise impacting the data as several tariff measures are expected to be announced in early April. We think the Fed should have greater clarity on the inflation outlook later in the year, possibly as soon as the end of the third quarter.
Could ongoing uncertainty derail those two rate cuts, though?
A persistent period of elevated uncertainty would almost certainly be growth negative and thus disinflationary. It is too early at this stage to project how long uncertainty will remain elevated. History shows, though, that uncertainty tends to mean revert, and thus a heightened period of uncertainty is unlikely to persist. From the Fed's perspective, we think they would be looking for the impact of uncertainty in the data rather than trying to make a preemptive call. Should the uncertainty manifest itself into significantly slower private spending, then the Fed would be prepared to address that with easier monetary policy.
How important was Powell's tone during the press conference? Because he seemed to be able to calm the markets following the release of the new projections.
Powell defended the status quo on rate cuts for 2025 at 2, despite the upward revision to inflation for a couple of reasons. Firstly, the upward revision to inflation mostly reflects the impacts of tariffs, which he regards as having only a one-off impact on the price level. That is, it's not inflationary. Secondly, potential policy implications from weaker growth that they forecast counter that of the higher inflation. Powell also in his press conference pushed back on the notion that the recent weakness in household and business survey data will flow through to real activity. He flagged that historically, sentiment has not been a good predictor or barometer of what is to happen with real activity, and we would concur with him on that point.
So what could throw the FOMC off its current course of 2 more cuts this year?
Powell outlined a couple of scenarios which may differ from the base case of 2 cuts that are indicated in the dot plot. Firstly, the Fed would cut policy more aggressively if either inflation fell faster than they anticipated or if the labour market conditions weakened materially. And secondly, the Fed may delay rate cuts by more than what's in the dot plot if inflation stays elevated.
Tom Kenny there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, March the 26th. Catch you tomorrow with what February inflation data could mean for the Reserve Bank of Australia. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.